Hello, everybody. Welcome to this weekend's episode of the Weekly Wrap. This is episode 7, and I'm really excited about this one. I've got a lot to unpack in this episode, and there's going to be a lot of great information. So, markets may have gotten too greedy too fast. We're going to discuss the macro environment, the Federal Reserve, market sentiment, market valuations, volatility. We're going to analyze some charts. We're going to look at stocks, Bitcoin, and some more stuff. So let's get right into it. I like to start these out with just like a little bit of news of what's going on. So let's start here with the economic reality of what we're facing right now. Stock valuations are not following the economy. So here's a little excerpt, and it says, here's a thought experiment. Imagine the economy is looking a bit end-of-cycle-y, unemployment close to as low as it has ever been, forecast growth low, interest rates being cut, and stocks high. Then fast forward 3 years to an economy that's not much bigger than it was and has unemployment slightly lower, growth forecasts to be much lower, and interest rates being raised. Where should stocks and other risky assets be? So the first little part of that was from 2019, and then when you fast forward 3 years, that's right now, 2022, and it says the right answer, well, at least for where stocks are right now, is up by a third. That end-cycle economy was 2019, and today's economy looks worse for investors on almost every measure, except the fat profits being made by companies. So the macro environment has really just kept declining since COVID. We've been going through a pandemic. We have global tensions rising. We've had runaway inflation. We have active war in Ukraine, and now we have Russia and China doing joint military exercises together. We have the price of oil skyrocketed and then came back down. The U.S. has dipped into its oil reserves. We can't seem to get a hold of inflation. There's a lot going on. And if you take a look at this chart on the right, economists' pessimism. So you can see the growth forecast for the next calendar year is falling sharply. And usually when it falls as sharply as it is now, it means we're about to enter into a recession, or we have already been in one. But the U.S. government refuses to admit that we are in a recession, so that's why you don't see a shaded recession in there right now. But we are, in fact, in a recession right now. We've had 2 consecutive quarters of negative real GDP growth, and that might turn into 3 consecutive quarters. We have inflation getting out of hand. We have the Fed raising rates at a faster pace than we've ever seen in history. There's a lot really happening, and stock valuations have not been following that. So this chart on the left here shows the after-crash recovery from COVID. You can see that real GDP has grown just over 2% since 2019. Payroll jobs have grown just under 1%, and consumer prices have grown 14%. So that's kind of the inflation that you're seeing. So we're paying higher prices, but we've seen small growth, and we've seen not a lot of jobs being created since 2019. But look at this. On the right, the S&P 500 is up about 30%. Forecast earnings are up over 30%. Growth in risk assets has grown over 40%. Value stocks have grown 15%. The Russell 2000, which is small caps, has grown almost 20%. And housing prices have gone up almost 50%. So there's a real disconnect here between assets like stocks and real estate and what's really happening in our economy with real GDP. Also, things are getting more expensive, and we're just not seeing that growth yet. Assets are growing at really fast paces. And usually you don't see risk assets growing as fast as they are now, or as they have been the past 3 years when the economy is as weak as it has been. So the Federal Reserve's job really is to fight the inflation problem that we've been having. Even though that inflation came in at 8.5% and that was lower than June's 9.1% print, that's still a really, really, really bad number. 8.5% is over quadruple what the Fed targets for a year. The Fed targets inflation to be 2% for the year, and to have it at 8.5% right now is not good. And In addition to that, even if inflation was able to be 0% for the rest of the year, we'd still finish with an inflation rate of 6% for the year. So maybe people are pricing in that inflation has peaked, and even if that's true, even if inflation has peaked, that doesn't mean that we're on the path to pushing it back to 2%. It could hang around 8%, 7%, 6% for a long time, and the Fed's going to need to fight that for a long time. So we could still be ways away from the Fed pivoting or even stopping raising rates, because even if they raised rates by 6% to 8%, the real interest rate would still be negative because it's lower than inflation. Mathematically, if you want the interest rates to be saving you from inflation, they need to be higher than inflation. And right now, interest rates are sitting somewhere between 2 and 2.5%, and the inflation rate is 8.5%. So real rates are still negative. So the Federal Reserve is keeping another 0.75% rate hike on the table. The Federal Reserve Bank of St. Louis president, James Bullard, said Thursday he is considering support for another large rate rise at the central bank's policy meeting next month, and added he is not ready to say the economy has seen the worst of the inflation surge. So he's saying that inflation may not even have peaked yet, let alone it had peaked and now it's just staying elevated between 6 and 8%. We should continue to move expeditiously to a level of the policy rate that will put significant downward pressure on inflation. And, quote, I don't really see why you want to drag out interest rate increases into next year, Mr. Bullard said in a Wall Street Journal interview. So basically what he's saying right there is if you don't want interest rates to be raised over the rest of this year and the following year, then they need to be really aggressive to have a chance at curbing inflation this year. So while he's not saying that they're going to not raise rates next year, he is saying that it would not be ideal for the economy to have rates continue to rise at this level through next year as well. But if they're going to be able to stop, they're going to have to go. They're going to have to be really aggressive now, and that's what they're doing. But even if they're aggressive through the rest of this year, that doesn't mean that they won't continue to keep rates high next year. Mr. Bullard said he isn't ready to say inflation has peaked, and it remains important for the Fed to get its target rate to a range of 3.75 to 4% by year end before the central bank can consider what it will do next year. He also said that he sees about an 18-month process of getting price pressures back to the Fed's 2% target, and predicted that path will likely be uneven, while adding, we've got a long way to go on to get inflation under control. The idea that inflation has peaked is a hope, but it's not statistically really in the data at this point, Mr. Bullard said. I'm hopeful the worst of the inflation surge is past, he said, though he added he expects high inflation to prove more persistent than what many parts of Wall Street think. And I have to agree with them there. I think a lot of people think that we just hit this peak inflation and then it just comes down as fast as it went up, but that's not the case. We can cap inflation for this year and have it at 0% through the rest of the year, but year over year it's still going to be over 6%, and that's over triple what the Fed targets. So they're not just going to be able to stop just because we've stopped inflation from growing. They actually have to push that number back down, and to do that, they have to be more aggressive than what a lot of people have been thinking and what the markets have really been pricing in. So with that, let's get into some charts. I have some great charts today. I have a lot of them. I have a lot to talk about. So let's just get into this first one. So this is the Fear and Greed Index. Usually when you see the Fear and Greed Index more towards the greed and extreme greed, that's when you'll see the markets start to sell off and come back down. And when you see the Fear and Greed Index towards fear and extreme fear, that's when you'll see the markets start to buy up and recover. That's why Warren Buffett, one of his most famous quotes is, to be a great investor, you have to be greedy when others are fearful and fearful when others are greedy. So you can see a year ago we were at extreme fear. The markets were kind of beginning selling off at that point. Risk assets like Cathie Wood stocks and a lot of hyper-growth technology stocks had been selling off quite aggressively. Only a month ago, we were at a reading of 33 in the fear range, close to extreme fear, as we were experiencing that low back in June and kind of recovering from there. And now we're more in this neutral range. So a lot of greed has been coming back into the markets for some time now. And it would make sense for the markets, if we're in this bear market, if we have not seen the end of the bear market, it would make sense for now to be a time to where stocks would start to sell off because there's a little bit too much greed coming back into the markets. So that leads us into the market sentiment. This chart shows excess pessimism versus excess optimism. And then on the top, we have a chart of the S&P 500. So you can see when there's a lot of excess optimism, that usually indicates that a market top is near a relative top. And then we see some selling, and vice versa. When you see a lot of excess pessimism in the market, that tends to mean the market can move up a little bit. And right now, we're really seeing a big divergence between excess optimism and pessimism. There's been a lot of optimism coming into the market and a lot of pessimism leaving the market. And that could lead to prices coming back down because there's just too much optimism in the markets right now. You can't always have that. And usually it is not bullish to have excess optimism. So, Q2 earnings. We had a beat rate so far of 60%. Typically, in a strong market, you'll see something closer to 70 or 75% beats. So this rally in the market following Q2 earnings hasn't really been based on anything fundamental. We're seeing a slowdown in growth, which would go hand in hand with our negative real growth in GDP. And it just goes to show the difference between what stock valuations are right now and what's really going on in the economy. And the prices of those assets can only stay like that for so long. This type of environment can only hold up for so long, where you're seeing all the fundamentals break down and you're still seeing prices at an elevated level. So this chart shows tech valuations. So this red dotted line in the middle is the average P/E ratio on tech stocks. This is following the NASDAQ 100. You saw following the COVID pandemic, when we had all that quantitative easing, money coming into the economy, we saw the valuations go up because when you have more money coming into the economy, when you have interest rates at zero, it pushes up the valuations of these risky assets. And now that we have money coming out of the economy, we've seen those and the interest rates rise. We've seen those valuations come back down. In June, they got below the average of 20, but they've since shot back up pretty sharply. And that would usually indicate that the valuations need to come down, especially when they start getting above the average. And before this environment in 2020, the average would have been even lower. Because you see the average actually is above the valuations for most of time until about 2020. So we are elevated valuation-wise with technology, which makes up most of the S&P 500. And it's just something to keep in mind as you're doing your analysis. So if we take a look at some money flows in the market, we see smart money, that's this blue line, continues to slow down going into this market. And we see dumb money just continue to come into the market. And usually in a time where we see a lot more dumb money going in than smart money, that means that we're about to see a pretty big correction. You saw smart money come in at the beginning of this bear market and then slow down. And pretty much every time there's a bear market rally, that's when the dumb money comes in. And so we're in the middle of a bear market rally right now, and we see a lot of dumb money coming in, and we see a lot of smart money really easing off as they have information that a lot of us don't have, and they might know that we're going to get some better prices in the future. So, market recoveries. This chart depicts the S&P 500 following a decline of 18% or more, and it charts it over a recession, which is this blue dotted line, what it typically does during a recession, and during no recession, which is this black line. So there's been a lot of debate of whether we're in a recession or not right now. If either way, This is where we are right now, is this red dotted line. We've fallen more than 18% to the bottom from the top, and we're in this little recovery right now, like right here. And you would say if you were in a recession, you'd expect the stock market to kind of sell back off and test this bottom again, and you'd expect it to form a base near the bottom that we had in June, and whether it sells off from there or recovers is just dependent on this unique situation. But if we were not in a recession, then you would expect stocks to continue to recover. I typically am of the opinion that that's not the case. I do believe that we are in a recession and we're still in the beginning stages of a recession. So we could maybe even see stocks come back to the bottom, test it, form a base, and then go lower. That's just my personal opinion. But this is what you typically see for a recession and for no recession. Since valuations are high in tech stocks right now, it wouldn't make a lot of sense. It wouldn't make a lot of fundamental sense to have stocks continue to buy back up like this, as that would just push those valuations higher over the averages. It would make more sense to have them come back down to that average, form a base, and then make a decision on whether they want to go lower or go higher. So this is something that I think is really helpful. So this has just recently happened this week. This is the 200-day moving average on the S&P 500 since 2000 to 2022. And this is the third time that it has rejected the 200-day moving average, and it's happened in bear markets. In the COVID market and in 2018, it actually didn't reject the 200-day moving average, even though those were bear markets. It came back through the 200-day and continued to recover. But as you can see, during the dot-com bubble and during the global financial crisis, we had rejections of the 200-day moving average. And each time that happened, the market continued to go lower, and it actually made new lows. So as you can see, we've made a rejection now here. It's been more than 2 days since we've rejected this, so that would be technically an official rejection. So according to the past 2 times that this has happened in pretty big bear markets, you would expect the market to come back at least to this low, if not make lower lows than what we saw in June. So that's definitely something to hold on to in your analysis of what's going on in the markets right now. But this is also important. We're in a midterm election year, and we're getting into the months leading up to that election, and volatility usually spikes going into midterm elections. As you can see on this chart, the blue bars are from midterm election years, and the teal green bars are from non-midterm election years, just all of their years, including just like, well, I guess that would still be midterm, so just forget about that. So midterm election years and all of the years. And you can see that in most months, volatility is actually higher in midterm election years, no matter what it is. But as you can see, in August, which is where we're at right now, September and October, that volatility really ramps up going into the election, and then after the election kind of comes back down. But it makes sense because there's a lot of uncertainty. We don't know what's going to happen, what type of policy, how's that going to affect the economy, and that volatility usually spikes and goes up. And in this type of a market, if we see volatility spike, that tends to mean that we're going to see a spike lower price-wise on the S&P 500 and on the other major indices. And that actually goes perfectly with this VIX 50-day cycle. So this 50-day cycle measures peak to trough for the VIX, which is the volatility index. And right now we've made a base on the VIX. It fits right in with this 50-day cycle. We've made a trough, and now it would make sense for us to move towards a peak, make another move in volatility, another move lower on the stock market. It's really useful to break down all these charts. I know that this is a lot of charts to be looking at, but when you have a lot of charts and you can make the connections between them, it really enhances your analysis of the markets. So I like to use all these charts together to form one analysis. So you can see that 14 out of 16 times that this has been correct, this has been the case, this 50-day cycle has held up. And so that predicts that the next peak would be in September, near the end of September, and then maybe we'd get a recovery there. If, say, we saw a big sell-off on the market, say we go back to the lows, we recover a little bit, not as much as we did this time maybe, and then if you're of the person that thinks that we haven't seen the low yet in the market, maybe you'd expect here sometime in October going into the election, have it really spike down or come back up. You never know. But these two charts are definitely going hand in hand. It would make sense to expect some volatility to come into the markets in the next couple weeks or month. So the last chart I have before we get into some technical analysis, I want to make the case for the bulls and the bears. I don't want to feel like I'm being too bearish or only present the bearish side of the story. So I have 4 charts of bear markets here, or just markets that we are correlated with technically. As you can see, for the bulls, I have a 90% correlation for this top one and an 86 correlation for the bottom one. And these would both make the argument that we've already seen the bottom in June, whether we come back down and test it again and then move higher, or come just above it and then recover. This top chart's from 1962. The bottom one is from 2015. And technically, we are very correlated with these markets right now, and this would be a case for the bulls. On the right side, we have a 91% correlation on the top, 85% correlation on the bottom. And these charts make more sense to me because the macro environment is also more aligned in these two. So this is 2008 from the global financial crisis, and this is from 1973 when inflation was really high. And you can see that in both these charts, it would make sense for us not to have seen a low yet. We still haven't seen that real capitulation to the downside, that extreme fear, panic, volatility spike. We haven't seen that yet. And this would make the argument for the bears that there are new lows coming in the market. And that this is just another bear market rally. And it's normal in a market to have bear market rallies. I believe the dot-com bubble had like 4 rallies of over 20%. And it still was continuing to make new lows. So there's cases for both sides here, but I'm still leaning a little bit bearish. I just want to bring in the case for the bulls so that I'm presenting all the information fairly. So let's get into some technical analysis. I don't have a ton of charts here. I just have Apple, the S&P 500, and Bitcoin are go-to regulars, but there's still some great stuff to look at here. So let's take a look. So Apple is testing support. Yet another week where this trend line holds on Apple, and it's moving aggressively to the upside. So Apple still looks a lot healthier than the rest of the market. It's been beating the market excessively. Right now we're testing that support around 171 to like 168. If we do break through there and we break through that trend line, the next place I would expect it to go is to this zone right here. That's got to be like 153 to 168, something in that range. It's a pretty big range, but we saw it bounce around in there a bunch of times before. So we'd expect it to get here next. I don't want to get ahead of myself and start talking about this yet or a break to the upside. I just want to talk about where we're at right now. Obviously, if it bounced off the support and moved up, there would be resistance at the all-time highs. This even could look like a triple top to some people maybe, which would be quite bearish if it moved aggressively to the downside. But Apple is still strong, and usually it is stronger than the market in most environments, in a bull market and in a bear market. So Apple's still holding on this support, but it is testing it right now, and it could break through this trend line, which would not be great. Let's move to the S&P 500, because to me, this is where all the action's at. So we have this trend line that's been going on the S&P 500 from the beginning of this bear market, and it's rejected it for a second time now. And we actually moved below this zone right here that had been respected a lot of times in the past. So I'm expecting the S&P 500 at least to move back down to this zone, fill this gap here from when it was coiling. And I'd expect some support right here for sure. There's a lot of buyers that'll come in right here. And after that, if it breaks through this level here, I would expect it to move lower. The moving average would probably be about right here at that point, which would make sense because there could be a line of support right here as well. I don't have it drawn out on this chart, but there could be a line of support right here and with the moving average coming up through here. So if it breaks through this level here next, I'd expect it to come back down to around the 4,000 level. And then the 4,000 level would be a really big support level. If it broke back through the 4,000 level, then yeah, we're opening up that June low again. And from there, it's free game. But one thing I wanted to mention was Elliott's wave theory. I don't know if that's actually the correct name of the theory, but Elliott's wave is a theory in markets that markets tend to move in legs of 2 and 3. And so if you look here, this would be our first leg down right here, is this initial leg. And then when it comes back and touches the trend line, it makes its second leg down, and then it came back up and touched the trend line again, and we're going to get that third leg maybe. So it would make sense for this bear market to move in legs of 3, and this would be our third leg. So that just goes hand in hand with that theory. I always thought that was a really interesting theory, but sometimes you can map it out on your charts. As you see, this is the trend line for the S&P 500. And every time it gets touched, it starts a new leg down. But yeah, it's also really hard for the S&P 500 to stay elevated above this moving average this high for this long of a period of time. You could see even in the bull market, when it'd get too high above the moving average, it'd have to come back down and touch it for a correction. And when it was below the moving average for too long, it'd have to come back up and touch it too. So this is a line that usually gets respected on the S&P 500. We've bounced off this trend line. I would not expect it to come back up at this point in the near term. I'm at least expecting it to come back down to here before anything else happens, but maybe we revisit the 4,000 level as well. Let's take a look at Bitcoin. So on the bottom here, I have a zoomed out version, but I want to look at this right here. It's zoomed in on this right here. This is where we're zoomed in on. So Bitcoin sold off with the NASDAQ and with stocks this week. As you can see, I mean, we were moving steadily up at one point, and then we sold off all the way through this zone, and now we're kind of buying up, testing it as a resistance, and wouldn't be surprised if we move back down to this level right here around like 19,000, 18,000 to 17,000. The reason I have this zoomed out graph here is to show the importance of what will happen if we break through this bottom zone right here, which is this right here that goes all the way back. If we break through this, it opens up 11,000 to 9,000 on Bitcoin. And I know nobody really wants to hear that, but I mean, if we have not broken through here and closed below here since Bitcoin initially made its run up to like 49,000 and then came back down, then went up to like 69,000. Like we have not been in a downtrend and broken through this line ever. So if we do, it's not a good sign for Bitcoin, and I expect us to get back down to this 11,000, 9,000 from back here. And while that may seem a bit extreme to some people, Bitcoin does move a lot harder than other assets. And it wouldn't be something that would surprise me. Obviously, I would buy a lot of it. If it went down here, this would be a good level to load the boat on Bitcoin. If you're a believer, which I personally am, this would be a generational buying level right here. I mean, this would be a really good opportunity if you wanted to invest long term. So that's what I'm looking at right now. We're going to really be watching this support level. We'll be watching it in our daily dose videos. That's all I had chart wise. If I want to give some of my takeaways before we head out. Obviously, some of my takeaways are that the markets did get a little bit bullish, too fast. I think the economy is heading one way and stocks are trying to head the other way, and you can only live in that fantasy land for so long. I think that reality is going to hit the markets here eventually when they realize what the Fed is going to have to do to not only cap inflation but push it down lower, and that typically is the best signal in the economy for what's going to happen, and for the markets for what's going to happen. That's usually the best indicator. And then even if that happens, if stocks come down, if valuations come down, that creates good long-term investment opportunities. So it's not a time to panic if things get super bearish, if the markets really sell off hard. That's a time to make great investments that can pay off into the future. Investors like you and I, the real advantage we have over large institutions is our ability to hold. We don't have to sell and go into defensive sectors. When things get bad, we can continue to add to our positions, and we can hold for an extremely long period of time, a longer period of time than most institutions can hold for. So that's our advantage. So really take take advantage of that advantage. Make sure you're buying quality assets at great prices and hold them for a long period of time, and you'll be able to see great returns. While it can be scary to look at what's going on in the markets, it's also a really great opportunity if you know what to invest in. And there's a lot of quality companies out there that could come down in price, and that would be a great opportunity to build wealth over the long term. So I won't ramble too much. I just don't want people to get too fearful when I put out these videos where I'm kind of showing the bear case a little bit. I think that it makes sense to look at that right now. It's good to be prepared so you're not dumping all your money in at bad prices. But at the same time, it's not a time to be selling out of your assets. It's a time to be adding to them. So I just think that that's really important. There's a lot of charts, a lot of information in this episode. So if you need to go back and re-listen to it, if you listened on Spotify, it could definitely be useful to go back on YouTube and watch. And if you're watching on YouTube and just want to get the audio over again, there's definitely a link to the podcast here on the channel if you want to listen. I want to thank everyone who's been listening and watching the show. This is still the early days. I'm really excited for what the future holds. Be sure to subscribe and follow if you're enjoying this type of content. We'll be with you every day next week for the Daily Dose. And until then, thank you for watching this one.